Everyday chat and chart live during the New York session. Here, real traders share the raw truth, their mindset, technical analysis, and execution. This is where real traders show their skill set. Welcome to Tradin TV. This is your stage to shine.
I'm sorry, my mic was off. Can everyone hear me now? Okay. Yes. So I'll go back from the start. Hello, good morning, and welcome to London Session Open. Heading into the trading week of September 29th to October 3rd, 2025. Markets are coming off a mixed prior week, which was September 22nd to September 26th, where inline PCE this number came out on Friday. This PCE inflation data supported the Fed cut hopes because they came in line with expectations, showing that the inflation is under control and it's stabilizing. Okay, it's still far from the 2% target, the Fed's target of 2% inflation, but it's stabilizing, so that's a positive sign, leading to a Friday rally, but overall weekly losses amid new Trump tariffs on pharmaceuticals and chips. So Trump is imposing new tariffs on pharmaceuticals and chips, which caused some weakness by the end of the session on Friday. Okay, that's for Friday, but let's move to geopolitics. The US-China talks about the soybean. The detentions are escalating, with China buying 0 US soybeans for the first time on record due to tariffs. They're shifting to Brazil and leaving US farmers with surplus risks. The vibe is cautiously bullish on easing, but tariffs are still causing some worries for investors. Dovish data could rally assets. Sticky inflation might strengthen the USD. As traders, we need to focus on the high impact news so that we avoid getting screenshot, as I explained previously. We need to use stops, diversify, and trade levels and not hype. All right, so let's move to the economic calendar. Here we have the economic calendar for this week. We start with Tuesday, which is September 30th. Today we don't have anything of high impact, so we move directly to Tuesday. On September 30th, tomorrow, we have the Reserve Bank of Australia interest rate decision, the RBA interest rate decision. The previous reading was at 3.6, and the forecast is a no change at 3.6, and so they're most likely not going to cut rates or raise rates. It's going to be 8:30 Dubai time in the morning. That's a very high impact, especially on the AUD, which is the Australian dollar. They're expecting a hold, like nothing's going to change. They're not going to change the interest rates. But a dovish cut, hence a weakened AUD. There might, if they cut rates, but it's not expected. But if they do cut rates, that would weaken the AUD. But if they increase or hike rates or have a hawkish tone after the interest rate decision, that might strengthen the AUD. All right. So that's pretty much it. The next one is the GDP coming from the US. Sorry, no, it's coming from UK. All right. We have UK's GDP. If it comes in high, now the previous reading was at 1.3. The current reading is at 1. Not the current, the forecasted reading is at 1.2. So a decrease in growth, which is GDP. 1 second, please. All right. So as I was saying, the previous reading was at 1.3%, and the forecast is at 1.2%. So they're expecting a contraction in the or less growth in UK's economy. All right. If it comes in higher than expected, so anything above 1.2 would be bullish for the GBP, and anything below 1.2 would be bearish for the GBP. All right. And of course, if they miss, if it comes in lower, this could boost the Bank of England cut odds. They might be cutting, or the odds of them cutting rates would increase because they need to cut rates to boost the economy. All right. The next one is the GDP quarter over quarter. All right. So the previous reading was at 0.7. The forecast is 0.3. So they're expecting less growth than the previous. So if it comes in high or higher than expected, that's bullish for the GBP. If it comes in lower, it's bearish for the GBP. So if it comes in positive, that's positive for the economy. If it's weak, it signals a slowdown, and that could increase the rate cut odds for the Bank of England. They might be cutting rates to boost the economy, as we said. The next one is the German CPI. Okay, so that's a high impact for Europe. Euro inflation proxy, so hotter reading, the previous reading was 0.1, the forecast is 0.3. So a hotter reading would delay the ECB easing, so easing meaning cutting rates, which would lift the euro, which would be bullish for the euro, and vice versa. All right. The next one is Chicago PMI. That's a moderate impact news or piece of news. That covers the USD regional factories. Above 50, it signals expansion. Below 50, signals contraction. So the previous reading was at 41.5, so it's very far off from 50. That's why I'm saying it's moderate. It needs time to signal any expansion, or because it's far off in the contraction zone. Okay. The next one is consumer confidence for the month of September. The previous reading was at 97.4. The current reading is at 96, or the forecast is 96. If this comes in stronger, that hints resilient spending, which is hawkish, or also bullish for the dollar. It's hawkish for the Fed. They wouldn't need to cut rates anymore, or it gives them more room to breathe. They wouldn't need to cut rates because that shows them that spending is still resilient, spending is still strong, and the economy is still strong. So they don't need, or they don't have the urgency to cut rates. Okay. If it comes in lower, that could mean exactly the opposite of what I just said. All right, the next one is the job openings. All right, we have the job openings. Yeah, the previous reading was 7.181 million. Um, so if it comes in higher than the previous, or higher than expected, for some reason the forecast numbers are still not out. So let's use the previous as a benchmark. If it comes in higher than the previous, that's a positive sign for the jobs market, which could also tell the Fed that nothing urgent, you don't need to cut rates this month or next month. So that reduces the odds of, or that weakens the odds of a Fed rate cut next month if it comes in stronger. But if it comes in weaker, that could boost the odds of a rate cut. Okay. And that's it for Tuesday. Let's move to the next day, which is Wednesday. Before moving to Wednesday, let me check if we have any questions. Do you guys have any questions? Hi, back at you. Surjit. Sound. Mic is muted. Now it's good, yeah? Okay, someone is asking, inflation is still sticky, limiting how aggressive central banks can be. That's correct. Equity is so strong inflows. Okay, gold steady as safe haven play. That's also correct. Okay. Limiting how aggressive central banks. All right. Loving nature guy. If smart money is indeed baiting retail stops, why would the big institutions leave such obvious footprints like fair value gap that retail traders can now easily identify and exploit? Surprisingly, you would think that most of the people use technical analysis and use the fair value gap or other stuff, but most of the users don't really know how to use it properly. And you would be surprised that the number is not that, or the percentage of people who know technical analysis properly are very are very few in the world. So let's say 30% of the world uses technical analysis. What about the 70%? Got my point? So yeah, you don't need to just think what the institutions are doing, or why are they doing such stuff. Just focus on you, and that's good enough to make money. You don't need to focus on someone else. Okay. All right. So let's move to Wednesday. Wednesday, October 1st, 2025. We start with the European CPI, the CPI coming from Europe. The inflation is at 2% in Europe, which is the target of any central bank in the world. Europe was the second in line to achieve the 2% target after Switzerland. The previous reading was at 2%. It is expected to stay around 2%. If it comes in higher, that could mean that the ECB should keep rates higher for longer to go back to the 2%. But if it starts going below 2%, that could mean that they need to cut rates to boost the economy and heat it up a little bit. Okay. And of course, if it comes in higher, that's bullish for the euro. If it comes in lower, that's bearish for the euro. Then we have the ADP non-farm employment change this number comes from the US. The previous reading was at 54,000. So that's a high impact. Private jobs preview. So if that came in strong, that's hawkish. If it came in weak, that is dovish for the Fed. And what else do we have? We have ISM manufacturing PMI. The previous reading was at 53. The current reading or the forecast is at 52. If above 50, that's positive for the economy, that shows growth. If it comes in lower than 50, that's a contraction signal Okay. Then we have the we had the PMI. Now we have the prices, the ISM manufacturing prices. The previous reading was at 63.7. This number shows the input costs. If it comes in lower, that cools inflation worries. If it comes in higher, that increases inflation. Right? And we just opened London session. Congratulations. All right, so let's finish this so that we can move to the charts. The next one is crude oil inventories. Previous reading was at minus 0.607. If it comes in like lower than this, like more in the minus, that could show a shortage in the inventories, which is bullish for the oil. That could mean either high demand or tight supply. Both are bullish for the oil. And the opposite. If it comes in like higher than expected or there's a surplus, that's bearish for the oil. That's it for Wednesday. Let's move to the next one, which is Thursday. We only have the initial jobless claims, which is the weekly number. Last week it came in lower than the previous and lower than expectations, which showed a strong or like a still resilient jobs market. Let's see this week how it turns out. If it comes in higher than expected, that's bad for the jobs market. If it comes in lower than expected or lower than the previous, that's positive for the jobs market, which could mean that the Fed doesn't need to cut rates as urgent as markets thought. Okay, so that's it for Thursday. Let's see what we have on Friday. Friday is a big day. We have the average hourly earnings. Previous was 0.3. The forecast is 0.3. That's the reading about wages. If it comes in hotter, that's inflationary hurting the cut bets. If it comes in lower than expected, that's that increases the bets of a rate cut. And of course, we have the non-farm payrolls, a very important number. The previous reading was at 22,000. The forecast is 39, so an increase. If they actually came in higher than the forecast and the previous, that's a positive sign for the labor's market or the jobs market, which could mean the Fed doesn't need to cut rates again in October, okay, or November. The next one is unemployment rate. Unemployment rate was like both unemployment and non-farm payroll last time were the reason the Fed cut rates. They cut 25 basis points because they saw like a higher unemployment reading and a lower non-farm payroll. So let's see this time. This could be detrimental to the future of the short-term rates in the US. Okay. What else do we have? We have the S&P Global Services PMI. The previous reading was positive. It was above 50, so which shows expansion in the services sector, which is the backbone of the economy. Then we have the ISM non-manufacturing PMI. The previous reading was at 52. The forecast is also at 52. So if it comes in higher than 50, not necessarily forecast or previous, if it comes in higher than 50, that shows expansion. Lower than 50 shows contraction. And we have not only the PMI number, we have the prices. So the previous reading was at 69.2. We don't have the forecast number yet. But any decline in this is dovish for the Fed. It shows or it increases the bets of a rate cut by the Federal Reserve. Okay. All right. Let me check your questions. All right. So To recap what we just explained on the chart on the calendar, no major holidays, but we need to watch for RBA, ECB data for AD and Euro. Earning season will ramp up soon. Thin trading could amp moves, so be careful. What else do we have? That's pretty much it. I think let's move to the charts. But before moving to the charts, do you have any questions? Do you guys have any questions? Okay. Okay, okay. Let me see. I think, let me stop sharing now. Okay. I think I'm getting sick, so I'm sorry if my voice is a bit off. Okay, let me share my charts. 1 second. All right. Happy to have you, Paul. Paul Ndambuki. Currently, quick recovery. What's your maximum percentage of capital you risk on a single trade? That depends. If I'm day trading, I wouldn't go above 0.5%. If I'm swing trading and it has like a high probability, that's a high probability setup, I would go somewhere around 4% per trade because, as I mentioned in previous live streams, I only trade like 10 to 15 trades a year. So that's why I risk this much per trade. But because each trade like lives around like 2 3 months as an open trade, so that's why I risk this much. Okay, so let's start with the DXY. DXY last week and the week before closed bullish. There was a very strong rejection after the Fed rate cut. It got rejected to the upside, and last week it closed bullish. Now we might be looking at the bottom of the DXY, but for some reason I have a weird feeling about DXY. I think it will go down to sweep this area before starting to go up, but it could have bottomed here. But let's see. We trade what we see, not what we feel. So this is a bullish close for the DXY. Let's go lower to the 1 day. Okay. So it's still below the major moving averages, which are the 100-day, 126 day moving average, and the 200-day moving average, which shows like overall bearishness. But the weekly close was bullish. That's why I would be careful selling the USD. But let's see. Okay. I think that we're going to 95.4 or like 95. I think so. I'm not sure, but let's see. So far, we're still in a downtrend. So far, we're still below the major moving averages. We have some bullish signs, but that's like nothing to rely on. We need more signals that the bottom has been made. All right, so that's it for the daily. Let's move to 4 hours. Let me check if we have. Yeah, that's done. Let's delete it. Okay. Um, like on the 4 hours, it's above almost all moving averages because of the recent jump in price. But let's see. You know what? Let me place an alert here. Around 99. So if it breaks 99, that could be another bullish signal, and I will be looking seriously for long positions on the USD. Okay, so that's it for the DXY. Let's move to Euro. Yeah, I exited this trade. I didn't delete it yet, so there it goes. The weekly was it's exactly the opposite of the DXY chart. So the week before we had this rejection after the Fed rate cut, and last week we had a bearish closing. But overall, we are still in an uptrend, at least for this wave. And now let me show you what I have on the monthly for Euro, because I saw something interesting last time I was here. So it broke the trend line that has been like intact for the past, I don't know, 17 years maybe. So it broke it, but it's still below the 200-day moving average, and it's still below the previous high. So technically, it did not break or it did not invalidate the downtrend yet. It has to break above 1.23 before it invalidates the downtrend. So if it reaches somewhere around the 1.2, I might be starting to think about shorting the euro against the USD. And this should coincide with the DXY reaching the 95 point mark, and this reaching the 1.2. So if it reaches the 1.2, I might be thinking of a sell with my stops above this area, and with my TP at least around the 1.02. Okay, so that's a very long-term trade, but it needs time to like develop and form. But I'm just like thinking out loud. Let's move to the daily. The daily, we're still above almost all the major moving averages, which is the 200 and the 126. Uh, it could keep going up from here. So that's that. If it breaks below the 1.14, that's another story. I think we might be starting the big drop. That's if the USD bottomed and the Euro USD topped, but I doubt it. Let's see. Let's move now to the GBP. Okay, we start with the weekly. Same. That's where we got filled on our TP, and then it started dropping. So the week before last week, it was a very bearish close, and last week broke the previous week's low, so it's also bearish. So guys, I'm looking at like the majors as they're somehow reversing. The GBP and the Euro were very bullish, like for the past, I don't know, couple of months or like even more. But recently, I'm seeing some signs of reversal in the majors. So the DXY could have bottomed, and the GBP and Euro might be reversing from here. So we need to pay close attention. All right. Any questions before we move to the next one? Thank you, Adept Mind. Let's go down to the daily. Okay, so we're still below this trend line. That's why I didn't want to hold my trade any longer than this. So took profit around the 37. It reached 37.20 maybe. So that was a pretty good exit. Still below. If it breaks this high, that's a different story. But as long as it's below this moving average, this trend line, and as long as it's showing these signs of weakness, I'll keep an eye on a short for the GBP USD. Other than that, it's still not very confirmed. I mean the reversal, so we need to wait. A good thing that I stopped trading for the end of the year. I mean swing trading, which is my main style of trading. Because like I don't see very obvious opportunities, it needs time to form. It needs like a week or two to form. So the good thing that I don't have to trade or find trades, because it will take time to form. Next is USDJPY. Almost stopped out on this one. Let's check. Yeah, I think if the USD bottomed, I believe this one will hit stop loss. The stop loss is around 151. So yeah, but I still see something. I still see that it might be going down. So it's too early to decide. So I will leave this. Either it hits a stop loss or starts going down in my favor. That's it. It closed well above the 200-day moving average, which is a bullish sign, but it's still below this high, and it did not break it or close above it. So we're still good, but most likely, from what I see, it's closing above major moving averages. So I believe this level wouldn't be very hard for it to break. Let's wait and see. What else do we have? Let's move to gold. Yeah, gold breaking all-time highs. Silver is going crazy, around 47 now. So you know what's fun? Let's go back to the beginning of the year. Okay, so at the beginning of the year, the silver was at 28. Okay, now it's at 47. Imagine 1 year. Look what happened. 65%. That's crazy. That's even like a bigger move than the gold's move. So as per my analysis, it should start topping around here and start like correcting. But let's wait and see. So silver is a great buy, but because I have these levels on my charts for a very long time, usually when I do analysis before the price reaches there, that analysis turns out to be right. So I will trust this level, and I will start looking for bearish signs here, which confirms our analysis on the DXY, which is the US dollar. Okay. Let's move now to gold. Forget about what's it called, the silver. Let's finish with gold. Does the GBP still have impact on euro nowadays? Not really. They're both impacted by the USD more than they affect each other. But of course, if you're talking about the international trade that happens between, or the internal trade that happens between UK and Europe, as UK has been a part of Europe for quite some time before exiting. So yeah, they affect each other, but not in that obvious way. Okay. If you want to see like a direct impact, look at USD against GBP or USD against Euro. No questions, great. Right. Everybody's favorite, thank you. Let's look at everybody's favorite, gold. All right, so the weekly is very, very bullish. Nothing is bullish. Nothing is more bullish than gold. Nothing to say here. It's like it's closing above all moving averages, all bands, everything. Nothing on its left to stop it. No resistance levels, no historical levels. It's making history as we speak. So nothing much to talk about on the weekly, and neither on the daily. Still very bullish. And by the way, what's fueling this rally, guys, fundamentally is the tensions between US and China, because the deadline of the trade deal is approaching. I think it will be on November 10th. So they still haven't reached any agreement regarding the tariff policy. Plus, there are tensions regarding the soybeans. China is boycotting the U.S. soybeans, leaving the U.S. farmers with surpluses, as I mentioned in the beginning. So that's why those tensions are fueling the gold, as well as Russia and Ukraine. It's still heating up. We have a lot of problems happening, or a lot of tensions happening in the Middle East now. So all of these factors are fueling up the gold's rally. But technically speaking, it's still very bullish. No signs of a reversal, no signs of a correction. But if that happens, I believe that we might be correcting sharply, because after a very strong rally, usually the correction, like when it starts, the proper correction, we're not talking about those. We're not talking about those are like temporary pauses in the market. It's not a correction. And when we talk correction, I'm talking this is a correction. Okay, so this is a correction. When it happens, it's most likely going to reach the 600 level, the 540, and the 450, and that's my most anticipated level. I'd love it to reach there. I'd be very happy buying gold at 3,450 if it reaches there in the near future. But for now, no signs of any corrections, no sign of any sharp drops. We're still very, very bullish. And that's it. That's it for today, guys. Do you have any questions? I'll give you 2 minutes. If we have any questions, I'll answer. Otherwise, I'll leave you with this and wish you good luck. Bitcoin analysis on 4 hour. Okay. You caught me. Once the Bitcoin on 4 hours. I start with the higher time frame to see the bias. Okay, so last week was bearish. The week before was also bearish. The daily, okay, daily is doing something. I want to see it breaking above this, which is the 118, to confirm a reversal. But like rejecting from here is not random. I believe like something is happening. It might be reversing up from here to continue the uptrend, of course. That's what I mean. But what's scaring me about this is that it's still below the 100-day moving averages. It's not able to close above. No, or actually it closed above it. No, it closed above it. So I think we're good. Let's see how it closes today, and we'll decide. But let's take a look at 4 hours. Okay, so for me, I'd wait for a correction somewhere around here, 110,000, to buy into this rejection. So I would buy at 110 with my stops below 109, or like at 109, targeting those moving averages around the 114,000 per Bitcoin. And that's it. He has a question. From your review 7 days ago, you mentioned that there are some few longs left on. Okay, my question is, we're still having that due to previous week. What's that? Let me see if I understand you well. You're asking me if I still have my longs on the currencies against the USD. I had GBP, I had Euro, and I had JPY. GBP's TP got hit, and the Euro I closed 80% and left 20%. But after I saw what happened last week, before the closing, I just placed it on break even. So the 20% of the Euro position got closed at break even. And what else? The JPY, the USDJPY is still open, and that's the last trade I have. I don't have any more trades this year, but I believe it will be like a losing one. But that's totally fine because we made good money on other ones. My question is, are we still having that? What do you mean exactly? Can you please rephrase your question? So, Trade TV, did I answer your question? Please answer my question before you. I will answer your question. Just like rephrase it because I don't understand it well. Okay, so I will give it another 2-3 minutes before we answer before we're leaving. Okay, so if your question was, I'm trying to understand the question, but if your question is, are we still having the same view? The answer is no, because most of them targets have been hit. So there's no need to still or to be still looking at the same bias. Especially that we're starting to see some rejections or reversals in the DXY, the Euro, the GBP. So those can fuel each other. Do you get me? So there's no need to keep looking at the same trend if it's done. There is a reason why I had my TPs there or my stops there, because I don't expect it to go any further than this. Simply because this is a very strong resistance or support level. I hope I answered your question. So, long story short, stay fluid. Whatever the market tells you, you react accordingly. Don't just be stuck to one bias or one trade idea. Okay, never marry your positions. Just be fluid. Whatever the market gives you, you react, and that's pretty much it. All right, guys. I hope this was helpful. If you have any questions, please drop them in the comment section below. If you need anything, you know where to find me. As always, trade responsibly. Take care of yourselves, and goodbye.